Hello, everyone. My name is Ann Mangelsdorf, and I am your host for this afternoon's Q&A. Welcome to the Q&A on our favorite topic, taxes. Now, I would like to move forward with introducing our speakers for this afternoon. So we have Samantha Roloff, Connor Wheeler, and Sarah Narkowitz with the Tax Center for Washington University. And we also have Sue Steinlage and Bob Jurgens, who are with the AARP and are currently available along with some other folks who are wonderfully providing voluntary tax preparation services through the St. Louis Arc. At this point, I am going to go ahead and turn it over to Sarah and the rest of the group to do their presentation.
So thank you, Anne. I am going to turn it over to my students, Samantha and Connor, who are going to talk to you today about some tax credits and some other issues. Samantha?
So welcome, everyone. Like Anne said, we're from the Washington University Low Income Taxpayer Clinic. So we are a law student run, I should know, clinic, but we are supervised by Sarah Narkowitz, who's our clinic director. And then we also have a supervising attorney, Jenny Stoll. So while they let us do most things, they don't give us the final say over anything, which is probably relieving to our clients since we're still students. So this is the second part in a two-part presentation. We were here talking about how to claim dependents on your tax return, and then just who we are and what we do. So this is the second part. And today in the second part, we're going to talk about the earned income tax credit, which Connor is going to talk to you about today, and then the child tax credit and the credit for other dependents. But I'll encourage you to go watch the first part if you haven't yet. But if not, Connor, take it away with the earned income tax credits.
Awesome. Thanks, Sam. Hi, everybody. Thanks for sharing part of your afternoon. As like Sam mentioned, I'm going to cover the earned income tax credit and then also hit on how it relates to disability. What is the earned income tax credit? As the name kind of applies or implies, it's for those who have earned income and it results in a tax credit. And so if you're a working individual, it can reduce your tax burden. It's a credit that applies to not only the taxpayer, but also they can claim children or dependents to increase the amount of their credit. And so I'm going to basically just explain some of the in and outs and qualifying factors for the credit. In addition to having earned income, it's intended for those with low to moderate income. So there is a phase out amount and total amounts that your income can't exceed to qualify for the credit. So we'll go through all that. And then at the bottom of the slide there, you can see that it does change occasionally from year to year. So an example is typically you have to be from age 25 to 65 to claim it. But for 2021, you must be at least 19 and there's no maximum age. So we'll get a little bit more into some of the age requirements and other requirements in the next few slides. So first, just an overview of what is earned income. It might seem like it's pretty straightforward, but based on, we kind of have two lists here, what it does include, what it doesn't include. There's a whole laundry list of different forms of income that can be counted as earned income or that might not be counted. Typically you probably think earned income as some sort of employment. So if you're employed and you earn wages from your employer, or if you're self-employed, things of that nature, anywhere that you might earn taxable income is typically also going to qualify as earned income for the purpose of this credit. But we can kind of go through some of the examples. So if you have union benefits, that can be included in an earned income. Certain disability benefits can be included, which we'll go more into depth on. But it's just important to see here that not all money that you might receive might qualify as earned income, because it's not just income, but the emphasis is on the word earned there. So for example, on the does not include side, Social Security, unemployment, child support, things that you may not necessarily think of as earning. So it's a lot of times tied to employment, as I mentioned, but a couple of other exceptions there too. So we'll move on to the next slide and talk about disability benefits a little bit. And so really the important thing here for disability benefits is to be included in earned income. So remember, you want earned income to qualify for the credit. So for disability benefits to be included, they basically need to be disability retirement benefits before you reach a minimum retirement age. So if you think about it as if you were still at an age with earning potential, and you're earning those disability retirement benefits, then it would be included. And so as you see lower down, so if you're receiving Social Security disability insurance or supplemental Social Security income, or disability insurance payments that you've paid a premium for, those would not be included as earned income. So as far as disability payments are concerned, we look for retirement benefits before you reach a retirement age. And so then just another note, for other government programs, typically if it uses federal funds, and if you receive some sort of refund, then that does not count as earned income for the purposes of the credit. We have some of the, as I mentioned, there are limits for the amount of income that you can earn, because this is a credit that's aimed at low and moderate incomes. And so you can see that the maximum amount that you can earn to still qualify for the credit varies by quite a bit, anywhere from 21,430 up to 57,414. This is your adjusted gross income that we're talking about. So it varies based on your filing status. So whether you file as married filing jointly, or if you have a different filing status, that'll impact the amount of income that you can have. And the amount of children or relatives that you claim also impacts the amount of income that you can earn. So it basically caps out. If you earn over a certain amount, then you don't qualify for the credit. And so what we have here is the 2021 amounts, and we'll show you the 2020 amounts just for comparison here. So you can see that they're somewhat similar. The limits have increased a little bit, specifically with the 0 children category. You can tell that so the first box there, if you're filing single in 2020, the cap was 15,820, whereas now it's 21,430. So that's a pretty significant increase. But going throughout the table, as you get down to the 1, 2, and 3 children claimed on your tax returns, it is a bit less of a difference. So just something to note that this does change annually. So it's something to just be aware of. And then also you'll note that there are investment income limits. So if you earn income from investments over a certain amount, then that may disqualify you for the credit. So you can see in 2021 below the box there, they have the maximum amount of investment income is 10,000. And then it also has the maximum credit amounts there. And so you can see that this credit can be pretty substantial. And so it's something that's worthwhile to think about and just be aware of. Like I mentioned earlier, not only can you claim the earned income credit for yourself if you have a qualifying income, but you can also claim it for a child or a relative. And so just a note here, a lot of times the IRS lingo refers to children, and that's just for a lot of their qualifying tests, because typically they are children. So there's usually an age requirement, but we'll see when we get into the disability special rules that the age requirement goes away for a disabled person. So when I say child, sometimes it could mean person with a disability who is older than what you would typically think of for a child. So just keep that in mind as we kind of walk through this. So first, they need to have a Social Security number. They can't be claimed by more than one person. So if you're claiming the earned income credit on behalf of yourself and a child, no other person can claim it on behalf of that child. And then there's a test to be a qualifying child. And so that's laid out on the next slide here, and it's a 4-part test. And so the first is what I was just talking about with the age requirement. So typically, if disability is not in the picture, the general rule is that the kid or the child has to be under the age of 19 and younger than the taxpayer. So keep in mind, our two parties here are the taxpayer and then the child that the taxpayer is claiming. So the child here would have to be under 19 and younger than the taxpayer. So there's a special exception for students. If you're a full-time student, then you just need to be under the age of 24, and you still need to be younger than the taxpayer. And then finally, what we're focusing on a little bit more here is disability. And so if the quote unquote child, they could be any age, but if they are permanently and totally disabled, then age is irrelevant. They can be any age, they can be older than the taxpayer, they could be younger than the taxpayer. So that's a bit of a catch-all. So there's the age requirement, which if you're claiming a child who's permanently and totally disabled does not apply. So then second, there's this relationship test, which basically is just, are you related to the child in some way? So child, stepchild, et cetera, et cetera. So looking to that, like family relationship. Third, they need to have lived with you for half of the year or more than half of the year. And then fourth, the qualifying child can't file a joint return with anybody. So if the child is married and files a joint return, then you would not be able to claim them. This goes a little bit more into like if the child does have a permanent and total disability. And again, on the age requirement, they can be any age and can be claimed for the earned income credit. Again, if they have a social security number and if they're permanently and totally disabled. And so that second requirement there is expanded upon in the white box, just talking about if they're able to engage in substantial gainful activity is kind of the key word, which a lot of times just comes down to, do they have an earning potential that's over a certain amount or not? And do they have a condition that impairs that earning potential, or is the reason why that earning potential might be lower? So there's different ways you can qualify through this. You can have a doctor's opinion, you can receive benefits from Social Security that basically just serve as a way to recognize a permanent and total disability. So then we have a few examples of how this could play out in reality. So if we have, going with the first example, if there's a parent that claims an 18-year-old child that lives with the parent, the child does not file a joint return and is not claimed by anybody else, then the parent, assuming that they have income that falls within the allowable levels, the parent would be able to claim the earned income credit not only for herself, but also for the child. So next we have a grandfather that could claim the 5-year-old grandson because the grandson lives with him, January to July, which would be more than half the year, and the child, or the grandson, who would be the qualifying child, is not claimed by anyone else. And so this kind of highlights that it doesn't have to be the entire year that they live with you, just more than half. And then also there are more family relationships than just a parent-child relationship. There are also several different qualifying relationships that can pass the relationship test. And then finally, we have an example of a 45-year-old sister claiming a 65-year-old brother. And the brother is permanently and totally disabled, lives with the sister, and is not claimed on anyone else's returns. And so this just illustrates what we're talking about with permanently and totally disabled, takes away any age requirement. So just because the brother is older than the sister can still claim the brother as a qualifying child. And the brother does not have to be under any certain age. The fact that the brother is 65 is fine. Whereas if the brother was not permanently and totally disabled, the brother would have to meet that 19-year-old threshold or the student and 24 threshold. So in this scenario, as it's written, though, this works out fine. So all three of these are examples of taxpayers claiming the earned income credit, not only for themselves, but also on behalf of a qualifying child.
Thanks, Connor. So that was the earned income tax credit that he went through. And now we'll go through another resource available to you to claim, and that's the child tax credit. That has also changed quite a bit over the past year or so. So in 2021, what this is a fully refundable credit with families for qualifying children. And like I said, it's been expanded through the American Rescue Plan. So you can kind of look at the bottom of this slide how it's been expanded over the past year. So before this past year, you were eligible or you were available to claim up to $2,000 subject to certain requirements per child for any child under the age of 16. And now in 2021, this has changed so that for children under 6 years old, the credit's been available for $3,600. For children 6 to 16, it's been $3,000. And it's been expanded for children age 17 as well, and that's been for $3,000. So to qualify for the child tax credit, there are requirements, just like there are for the earned income tax credit, claiming dependents, things like that. So the test to qualify for the child tax credit is you must have at least one qualifying child with a valid social security number. Of course, the IRS never makes it easy on anyone, and it's a different test for qualifying child for the child tax credit than for the earned income tax credit. So we're going to go through that. Second, you, the taxpayer, must file a return, or if you don't file a return, you must give the IRS some non-filer information so they have some information about you. 3, you must live in a main home in the United States for at least half of the year. So you just need to live in the US. And then lastly, you must meet the income limitations as well. This is targeted towards moderate to low income taxpayers. You can see the income limitations are $75,000 for single taxpayers, $112,000 for head of household, and $150,000 for taxpayers filing jointly. And this credit also phases out. So for every $1,000 of income you have over the income limitations, the credit is reduced by $50. So what is the test for qualifying child for the child tax credit? This test is a little more stringent than the test to claim someone for the earned income tax credit. So this is a 7-part test, so bear with me. The child must not have turned 18 before January 1st of 2022. So what that means is to claim someone as a child for the child tax credit, they have to be 17 or younger. There's a hard cutoff with age limitations. No matter what, they must be under 18. There's the relationship test, which is, I actually believe, the same as for the earned income tax credit. So child, stepchild, foster child, sibling, any variation of those, or a descendant of any of these. That's a fancy legal term for a child of any of those people. So a child of your siblings, so a niece or a nephew, a child of your child, a grandchild. Third, they need to not have provided more than half of their own support during the year. So this is different than the earned income requirements. That just means that you have to pay for more than half of their expenses over the year. The child needs to have lived with you for more than half the year. They must be properly claimed as a dependent on your tax return, which is in the last session if you want to go watch that recording of how to properly claim someone as a dependent. They must also not file a joint return with their spouse. So you can't claim someone that is married and filing a joint return with a spouse. And they must be a US citizen, a US national, or a US resident alien. So this has changed a little bit over 2021. I'm sure a lot of you know about this because the way that the advanced child tax credit has functioned over 2021 is you were supposed to have received 6 monthly payments over the course of the year for half of the amount of the child tax credit you were entitled to. So they're supposed to go out as monthly payments. If you didn't receive the first month for some reason, they're supposed to be accelerated over the year. And then you receive half of the other half of the credit after filing your 2021 return. This gets a little tricky, obviously, because there's a lot of people the IRS is keeping track of. So the way that you're supposed to kind of keep track of this on your return is the IRS sends you a letter 6419 if you received any monthly child tax credit payments. And this letter specifies what the IRS has on file for how many payments you received, the amount of payments you received, and then the amount of qualifying children that you claimed. And you use this letter to reconcile the amount you received and the amount of qualifying children you claimed on your tax return for 2021. And when you kind of reconcile this, you can there's three options. You can say, okay, great, I was paid the exact correct amount and now I'm entitled to the other half. Great, perfect, easy. You can have been underpaid over the year. So you can say, I was supposed to receive this much money and I only received this much. I'm entitled to an extra refund on top of that other half a credit I'm entitled to. So you're entitled to a refund. Or the third option is that you were overpaid throughout the year. So the IRS actually paid you more than what you were supposed to receive. And while you might want to say, oh, great, they gave me more money, you shouldn't, because that can lead to a liability with the IRS. And you should tell them that you have this liability and you may actually owe them money. So that is how you reconcile it on your tax return for this year. Like I said, though, the test for if you can claim someone as the child tax credit is actually kind of a strict test. There's a hard age limit that the child cannot be 18 years old or older. You must provide over half their support, and there's like certain relationship tests. So if you're not able to claim someone for the child tax credit, but they're claimed as a dependent on your tax return, you may be able to use what's called the credit for other dependents, which is kind of an alternative to the child tax credit. So what it is it's up to a $500 non-refundable credit for each dependent. And what that means is you'll never get a refund from this credit, but it will reduce your tax liability. And it's available for all dependents who can't be claimed for the child tax credit if they meet the test for credit for other dependents. And it's really good for dependents over age 17, dependent parents, because those are never eligible for the child tax credit, or for other dependents claimed on your tax return, but cannot qualify for the child tax credit. So the test for credit for other dependents is 3-part, and it's that you can properly claim someone as a dependent on your tax return. The second part is that you can't claim them for the child tax credit. And then the third part is that the dependent is a U.S. citizen, a U.S. national, or a U.S. resident alien. This also has a phase out, but the income limitations are actually higher than they are for the child tax credit. So the credit phases out when your income exceeds $200,000, or if you file jointly, $400,000. So in summary, we talked about a lot today. We threw some credits at you. So Connor talked about the earned income tax credit, and I talked about the child tax credit. It's important to note that they both talk about what's called a qualifying child to claim that for someone, but it's different tests for the qualifying child. So the earned income tax credit, like Connor said, allows you to claim a child that's over age 19 if they're permanently and totally disabled. The support tests aren't the same versus the child tax credit. You cannot claim anyone over the age of 17, even if they do have a permanent and total disability. And if that's the case, then look to the credit for other dependents, which doesn't provide as robust of a refund or a tax break, but it does provide, some non-refundable credit to your tax liability for the year. So that is what we have to talk to you about today. If you have any questions, here's our contact information. Sarah Narkowitz, our clinic director, who's on today, also our supervising attorney, Jenny Stoll. And here's our phone number, our website, and our Facebook page.
Thank you, Samantha and Connor. What a great presentation. I think it was thorough and gave people some good information. So I do have a couple of questions for both the WashU folks and also for our AARP folks so that our listeners can have a better understanding of how they can be helped. So in order to use all of the wonderful information that you all have provided and your resources, tell us a little bit about what type of clientele, even though we did talk about it in part one, what type of clientele do you currently serve?
So, and we serve taxpayers that are in direct controversy with the IRS. So we are not a tax preparation operation, but once someone has received one of those letters from the IRS that's scary, they can come to us. Our other criteria is that they have to be at or below 250% of the poverty line. So for one person, that's about $32,800. And final criteria, which doesn't come up very often, is that the amount in controversy has to be less than $50,000 for any given year. Can be
Wonderful.
multiple years that exceed that, but 1 year is 50.
And then Sue and Bob, I'll let you all fight over who answers this question, and you both may wish to do that. But if people were interested in reaching out to you all, tell us a little bit about what you provide.
So we operate under what's called a tax counseling for the elderly grant and a VITA grant. We have both under the AARP auspices. What it boils down to is we can provide tax preparation, filing services for anyone who requests it, as long as the type of tax return that's required is in our wheelhouse in terms of what we're certified to do. In the big picture, it means we can do most individual tax returns unless the people are self-employed and have a net loss or have more than $25,000 of expenses, or we cannot do tax returns that require that we do depreciation. Like if you had a rental apartment where you have to depreciate it over time, we are not certified to do those. Pretty much everything else we can do. Under the TCE grant, we don't have any income limits, although candidly, if people have a lot of money, we usually do their tax return, grit our teeth, and suggest that we would sure appreciate it if they would go to a paid preparer next year so that people who can't afford a paid preparer can use our service. And I think that's probably it in the big picture. Sue, did you have anything to add?
No, I think that covers things pretty well. And it is always trying to peel off the people that maybe should be going someplace else, but they usually respond to a little guilt. So even though we don't have restrictions, people are responsive to that. So, and I'm finding the marketplace insurance to be the largest headache this year than I have seen. Just because of a few clients, I think, who Bob went out and found.
Yeah, and I would join in that it's amazing how many people don't remember that they got their $1,400.
It is amazing.
It goes fast.
Yeah, it does.
I'm sure the same with the monthly child care tax credits as well.
That's true, although most of them can remember getting the checks.
Okay.
And they also remember that they're not getting them now. So it'll be interesting to see what Congress does later this year. You know, it's an election year, and both of the things we talked primarily about today, the earned income credit and the child tax credit, were really juiced up beneficially for taxpayers for this year only. You know, like the age limit expansion and how much money you get for the child tax credit. I don't know, it'll probably be irresistible for Congress not to keep those in place or maybe even make them better going forward. But right now they're gone after this year.
Well, it's hard to believe, but another 30 minutes has gone by. It's gone by very quickly for me. I want to thank all of you for being here, especially to talk about something that's scary and unpleasant for most people, and necessary at the same time. So thank you all for being here, for explaining what you all do. for explaining some good information about child care tax credits and earned income tax credits. And we look forward to working with you all. Thanks again.